Well, hello there and happy Monday. You tuned into MyStockScanner live, powered by the 3-Point Playbook. It's a new week, it's new headlines, and there's plenty of fresh opportunities for all of us. We're cutting through the noise and we're running today's top stocks through three simple questions. We always do that. Is it a quality stock? Does it have an upside? And is now the right time to buy? And as you can see from your screen, hans-henrik has the day off. He'll be back on Wednesday. He also have a webinar on Wednesday about nuclear. Takes place Wednesday evening at 7 o'clock, 1900 hours, if you want it that way. And of course, he'll be on the show on Wednesday as well. But today it will be Mr. Liam Flavel, who is the man with the answers. I'm Jesper Behrens. I'll be the man with the questions, but I won't be alone because I have members and users who have been asking us questions on our email, which is FOMO, F-O-M-O, at MyStockScanner.com. And because it's Monday, we're going to run through the 3-Point Playbook portfolio, which today I'll take a look up in my one corner, 33% up. Liam, if I asked you, at January 1st, if we come into October and you would be up by 33%, what would your answer have been?
It's not a bad number, is it? Yeah, no, we'd have been really impressed, and we are really impressed. We're in a bull market at the moment; everything seems to be going up, but yeah, we're very, very happy with our performance.
Yeah, and talking about being up, we're going to be, because it is another up day, the Danish market a little bit uneven, minus 0.1% at the moment. But if we look to futures, they're all up. Japan went berserk. And on the show today, we will be talking about other things that sort of is making a wobble. Ørsted, we will be talking Max 7, NVIDIA, Microsoft, Tesla, Salesforce. And if we can cool you down with some water, we'll do that at the end. But let's kick in with the number of the day. It's 6%. It's a number that has a nice sound and rhythm to it. It's a percentage of sales in one industry, 6% of that sales in the industry. If you can guess what it is, I'll tell you at the end of the show, but guess in the meantime. And let's get into it. The news of the day, US shutdown. We are coming up on almost a full week. Japan, at the same time, goes berserk, goes almost up 5%. Gold is up, silver is up, Bitcoin is up, Ethereum is up, oil is up. Liam, how is this possible?
There's a lot of numbers in that, isn't there? A lot of things going up. Most of them, I think, if we look at gold, silver, any Bitcoin, any of those cryptos, things like that, people look at that as a store of value. And I always say to people, you're not necessarily looking at those values going up. What you're looking at is the value of the US dollar holdings going down. So your money is actually becoming worthless, and people aren't trusting that your money is going to be worth as much in the future. For stocks, I think we're in a massive bull market. Benjamin Graham, who taught Warren Buffett, actually called it irrational exuberance, which is when everyone just goes absolutely insane on stocks and just buys anything that goes up. And that just pushes the prices up and up and up. So we're in that sort of territory at the moment, I think.
It's interesting when you mention somebody taught Warren Buffett. I almost think it's God you're talking about, but that's nothing to do with Warren's age. No, he's not quite that old. But one of the things that's really driving the market is, of course, the Magnificent Seven, the 7 big stocks in the American market. And is that really what's holding S&P 500, the stock market, the 500 big stocks up? Is that just the top 7?
I think to a larger extent, when you compare, I had a quick look earlier on. I won't show it on the chart because it's just a big number, but the S&P 500 is up around 26%. If you look on an equal weighted basis, that's all stocks equally weighted within the index and represented in the index. If you look at the SPY, which is just its market capitalization weighted, so NVIDIA takes up, 14, 15% of the index, that one's up 41%. So you can see there that those big the market cap stocks are actually pulling the index up by a good 15, 16%.
So all engines need a catalyst. It needs a driver. It needs a fuel to be put into that. And AI is the big fuel. We have been looking at NVIDIA so many times. That's no secret, because also $4 trillion company. Why not? But as a matter of fact, if we should look into something from the Magnificent Seven that still has an upside and still could be investable, Liam, what's your choice?
Choice. Well, I mean, we got 6 others to choose from, or 5, because one of them's sort of I wouldn't go near.
I will get to the worst one later.
Yes. But if we share my screen very quickly, I will show you this small stock called Microsoft, which not many people have heard of, I don't think.
They have.
Yeah, I won't go through the description. Everyone knows what the description is, but from a playbook point of view, there is some red, but that's because their returns on equity and income and equity and capital employed was so high in the first place, and it's dropping down a bit because they're investing so much over the last few years into AI and hyperscaling their data centers. But you can see the 3 things that I really look at, the 2 major ones that people know about: quality score of 98 out of 100, one of the top companies that in the US market. Also, the PEG ratio shows us that there is some growth in the tank potentially. At 2.76, it's quite high. We prefer it below 2 or maybe 2.5. But you can see the earnings.
Can I ask Liam, why is that? Why is it around 2 that you want it?
Okay, because the lower the number, the more expected growth is not priced into the price itself. So the PEG ratio is actually the PE ratio divided by the earnings expectations over the next year in this case. So this shows, the smaller the number. If we go, a lot of the stocks we look at in the playbook are below 1. And that gives us that ability to have that explosive growth going up. Microsoft's a rather big company, so they don't tend to go for explosive growth. So we have seen them all go up.
Yeah, exactly. But that is sort of the key, is that these are not companies that will double in size, because it's simply impossible. In a year, we would go in a year.
In a year, we would have said, but Nvidia doubled in size last year. So these things, I think the use of the word impossible sort of goes out the window in this day and age. Yeah. So everything's green. You can see that. So from a quality point of view, the stock is absolutely rock solid. And then we go into point 2.
I think that Liam just lost connection.
Oh, I'm back again. Sorry about that.
Good to hear. No, because else I would have to do the analysis, and I'm not sure that the viewers would want that.
It's better than that other buffoon we sometimes have on. What was his name? Henry something or other. But on to valuations on Microsoft. So the Microsoft valuation actually looks pretty good. I mean, what we do need to do is just drop down the
and why do you do that? Explain why do you do that?
So what we're trying to do is we're trying to match the tops and the bottoms of the movement of the stock. The green, the bull case, is the top. So this is where, at its absolute peak, investors have been willing to pay that sort of valuation for Microsoft. And if we go down at the same level, we go down with in the bear case, this is the lowest PE ratio that investors have wanted to pay. So you can see here up on the left hand side, that's the worst case scenario is still a PE ratio of 34, which is pretty racy. It's okay for a tech stock maybe, but it shows quite a lot of growth is what investors are expecting. So here you can see that by the end of next year, if our workings out are correct, then we'll pretty much break even at the worst case scenario on Microsoft. Best case scenario, we'll return 35%. What we think is going to happen is pretty much in line with the analysts, and we're going to return 20%. So to me, even though we're quite high up in this band, Microsoft could well be a buy, because we're looking into next year's earnings growth coming through. So it's a difficult one, but out of all of them, they're my second favorite, I think, out of the Mag 7.
Let's go to the other end, because there is another end of Magnificent 7. There is a stock that sort of be the one that we wouldn't invest in, and for reasons. If we bring it up on the screen, it's no secret. It's a car company, and you guys have really, should I say, strong feelings about car companies in general, but this one in particular. What is it that's wrong, in your opinion, with Tesla?
I mean, with hans-henrik, we'd be here for half an hour talking about these things. True. But what we always say, Tesla is a quality stock. You can see that 81, not quite as high as Microsoft, but it is still a quality stock. But the problem is, you see these numbers coming down. So the background on this particular metric is grey, and that's because it's sort of in the middle. We had big sort of earnings per share a couple of years ago, It's come down. Analysts think it's going to lose more EPS this year and then potentially go up. And people who have listened to me before, they know that I don't like that situation, because you're effectively, the company's promising we're going to sell more next year. We're going to sell this number, and whether they do or not is, I'd rather put my money somewhere else where actually the earnings are looking to go up all the way. So, from our point of view, there are some warning signs in there. The real sort of area that we shy away from comes back to valuations. So we can see here, I'll just reset everything. You can see here that actually the stock is well above where the bull line is. So it's actually very, very overpriced. And if we're looking at the PE ratio, which is effectively a proxy for how much risk investors want to take on, a 200 PE ratio, that means it will take 400 years, to actually pay back your money, your investment out of the earnings. So it's got a massively increase in value in sales to get up there, and we just can't see that happening.
Either that, or we need some new meds that can take us to 400 years. But let's not get into that. We're not talking pharma. We're not talking pharma today. But one thing is the Magnificent Seven, Liam, is that these are the drivers of the market. But it also means if they are the driver of the markets, then outside in the SP 500, maybe just below the Magnificent Seven, you have stocks that's taken a beating, but might start to look interesting. I know that one that we talked about before we went on the show is Salesforce CRM. How come it's been so unpopular? How come it's gone so out of fashion?
AI is the real reason. So they make software that manages people's inventories, manages people's relationships with clients and things like that. And the massive hype from AI and the big push, a couple of the big pushes in the areas are doing your own coding. So vibe coding, they call it, which is a horrible expression, but it basically means you don't need as many developers because the AI can create all this software for you at the touch of a button. You just have to describe what you want, and it will go away and come back with a finished product. The problem that people are finding now, and I found it, I was coding over the weekend doing some stuff, and actually I probably used 4 or 5 agents to generate some code for me. Not one single agent managed to do it correctly. And in fact, one of them just screwed up so badly, I just went back and said, no, delete all of that and go for it. And I'm seeing that here in our in our company. What people were expecting with companies like Salesforce is that AI would come in and people would just be able to generate. Would people be able to say, "Well, just give me a system like CRM. It's not going to cost anything. I don't have to pay CRM that money anymore." So that's why these companies have dropped down. What we're finding, though, is that everyone's getting to that point of saying, actually, it doesn't work quite as well as that, does it? So we need to go back to Salesforce and with the bigging ball out saying, oh, yeah, we'd really like to buy your software. So if we look at the company, again, everything is green. I mean, it looks even better than Microsoft. So, and you look at the PEG ratio here. So you've got a quality score of 94. Earnings are shooting up still. So analysts never really lost too much faith in the fact that the company was going to make money. The PEG ratio is 0.44. So that means there's some really good explosive growth potential in there. From our point of view, where you put these sort of elements is a bit more up to you on this sort of stock. But you can see the stock is in a downturn at the moment, but it's still got massive potential going forward when it turns. We don't know when that is, and that's where the third part of the 3-point playbook comes in, is to say, okay, since the stock is a high quality, it's got a low valuation, but where do we really want to jump into it? And from here, I'd want to see the stock making significant inroads come up, maybe getting above the 50-day moving average, which is this green line here, which is one of our key elements that we look for. Coming up, probably bouncing and using it as support, a bit like a trampoline to bounce back up again, and then really eating some distance into that 200-day SMA there.
Liam, one of the things that I know a lot of people are asking us about on our email, FOMO@mystockscanner.com, is why do you want that bounce? Why do you need that bounce? If it starts going up, it goes up. Don't you miss out then?
No, not necessarily. Well, you can. And sometimes it just goes straight through and just carries all the way up again. And we think, oh, okay, we missed our opportunity there. But what you can see here is on the other side. You can see that the stock has used the 50 or the 20-day, which is the red, as a bouncing point to come back down. So what if we'd have come in here, thought, okay, here on the 30th of June, it actually closed above the SMA, so why don't we buy here? It didn't actually confirm that by going up, coming down, and starting to use this as that trampoline to bounce us back up again. So you can see it's been in trouble recently. When you go the other way, you can see these moving averages are being used as that bouncing point, that support point up here. So that's what we want to use. We just want to know that we're in that trend, and investors are starting to look at the upside rather than being nervous about the downside.
And talking about downside, I'm looking up to my screen now just to see how Ørsted is doing, because we had some questions about Ørsted, especially after news broke on Friday night that they were going to let go of quite a significant amount of their employees,
Yes.
up toward 20%. It doesn't seem to be affecting the stock today as it's up 0.5%, but people, as I said, have been asking about Ørsted. Definitely not a buy now moment because uncertainty is so big, but what are we looking at with Ørsted?
Ørsted is one that we wouldn't have touched. And if I just drop straight back down to TradingView down here, we can see that our MTI, which is our trend indicator, and also the TPI, which is showing where the turning points might be, all went red back in August time. So just after the drop. So but to be perfectly honest, we wouldn't have been in the stock in the first place because it's been in a downtrend for quite a while now, and we've set that out there.
Fit in the screen here because it's been so high. So
no, exactly. So it's something we don't try and catch a falling knife in there. Often you find that these sort of moments of shedding workers is terrible for the workers, but actually from a company perspective it reduces their costs. So these times can be catalysts for a turnaround. And we believed Nova was going to be like that a couple of weeks ago, but then there was the announcement from the US, from Trump, about the Trump RX platform to reduce down costs, and that sort of sent Nova down a bit more. Whether this is it or not, again, we would wait. The company's not that high quality for us. It's in a really struggling industry, which, I mean, energy should be powering everything. Upwards on here. The US have just got rid of one of the big wind farms that was just about to be completed, which is why Ørsted has had to go out for that big rights issue recently. So that's that we wouldn't touch Ørsted for a while.
Talking about things that you have in your portfolio or not, it's Monday, and every Monday we take a look at the 3-point playbook portfolio. And this is we have to disclose that this is investments. This is money in it. We're not recommending any stocks at any time.
Yep.
We're talking about them. Your portfolio is up just a notch over 33%. We talked about it at the beginning of the show, if that was a number that you guys were aiming for. What are some of the top scorers amongst the stocks that you have in your portfolio?
Well, the two biggest ones that we've got at the moment are TSM, which is Taiwan Semiconductors, which make all the chips, generally the biggest and the best, most advanced chips in the world, and Barrick Mining. So two very different. Going back to what we discussed at the beginning of the program, it was what's powering up at the moment. Gold and the AI stocks are powering up. TSM powers the AI stocks. Barrick actually has agreements to sell gold around the world. So, both of those stocks, unsurprisingly, are the winners out of the portfolio. But we have quite a few others. I think our average winner, if we come down here, is 25%, and our average loser is just 6%, -6%. So,
there's two things that always strikes me when we look at the portfolio, because it's not because like you have 90% winners and 10% losers. As a matter of fact, it's almost evenly split on the ones that goes up and down. I think it's 54 and
it's
46
57 and 42. I think 43. Yeah.
And that means that you're just quick to get out of a stock if it starts losing. Yeah. And you'll hang on to stocks that, of course, are doing well, like you did during the defense stocks boom, was that you hung on to those for a long time.
Yeah. What we're trying to do with the 3-point playbook, we're trying to skew the odds in our favor. A bit like a casino. We just need to tip those odds a little bit into our favor, 5 or 10%, and all of a sudden we're in a great position. So, that means that when we get into a stock, it's because the fundamentals are right, the valuations are right, but also the timing is right from the stock. So we look at that moving average that we talked about earlier. If a stock then turns around and dumps back down again, we're not in love with the stock. We'll just sell it. And if it starts going back up and it looks good, we'll just buy it again.
And that's one of the things that's so important about having a portfolio, is to have a strategy ready before you start your portfolio. Don't get it while you have a portfolio, while you build it, because you will get attached. You will get, I won't say you will fall in love with stocks, but some you might do. Novo is probably the biggest love of many stockholders'
Yes.
life in Denmark. And we're not going to talk about it again today, as I said. But one thing I'm always looking at in portfolios, whether it be yours or if you look at other people's portfolios that's public, like some of the bigger investors, is there sort of what's it called? Sectionality division.
Oh, yeah.
Your
So
sector. Your sector.
sector
Yeah.
allocations
Sorry.
and things like
Yeah.
that. We sort of, you can do that, and diversifying across multiple sectors can be a really important thing to do. And we do it by default, but we don't aim to do it. We don't sit down and say, well, we only want 25% in tech. We only want 25% in industrial. You can see here we're in 40% in industrial at the moment. What we found with our playbook portfolio is basically the screener spits out all these stocks that we can look at, and we tend to find that once we start looking at them over time, the screener starts, as the defence industry, wavered in the last 3 months. We made 200% on one of our stocks, about 150 on another. We sold those because the sectors was starting to rotate away from that, and the system gave us sell signals. So the 3-point playbook sort of process that we go through sort of automatically balances us out across what are the growing and winning sectors.
And talking about sectors, one of the things that you added to MyStockScanner.com, the website, is that you have seasonality. I mixed those and
Yes.
sectionality up, so it became a new word. We'll patent that
I think
word.
that was sexuality, wasn't it? But yeah.
Well, that might sell as well. But one of the things that you're working on, and I know that this is a tiny bit premature, but you are working on sectors in that sense that you
Yep.
can take a look at the full sector. Do you dare
Yes.
say
Yeah.
when it will be available? I know, careful.
I can give you a date, but it'll be completely wrong. We're working hard on it at the moment. We think we'll get the first cut for us to be playing with properly, for you and Hans-Henrik to be playing with in the next couple of weeks, probably sometime in November, I would guess. But it's really exciting to actually play with the test version that we've got at the moment, just myself and Hams, our developer, because it's starting to show us early patterns on what's moving around in the industry, what's going up and what's starting to fade. And we think it's going to be a game changer for how we operate.
And there's so many things coming to MyStockScanner.com over the coming time. The show is new. We barely sent for a full week yet.
Yep.
But it's one of the things that we're going to increase. We're going to do more. You have more webinars coming. Of course, you'll do educationals, as you have always done. One thing I know that's not in your sector book in the portfolio is music. Is there a reason for that, Liam?
We try and stay away from DJs and people like that as much as possible. Yeah, we try and
terrible
get away
people.
from. I don't. I don't know how you find it, but actually, with tech stocks, sometimes I'm the worst one to look at them because I know too much information. Sometimes you need that high level, and that's it. Music, nothing's really come up so far. It's
it could be that there's artists that are monopolizing the market, and the 6% we were talking today's number is a matter of fact that the amount of the total sales of albums last year that Taylor Swift sold. 6% of the entire market was Taylor Swift last year. And
she just released. Is she happy? She looks quite happy, actually.
That's a discussion you and me shouldn't have.
Yeah.
The Life of a Showgirl was just put out the other day. It sold more than 2.7 million albums, 24 hours. Good on her. When we're back on Wednesday, Hans-Henrik will be back. We'll also give you the Wednesday watch list, and Wednesday night, 7 o'clock, there will be a webinar about nuclear. When we are broadcasting on Friday, it will be with, I'm almost going to say signature, because people really like it, and that's good. Friday face-off, we pit two stocks against one another. And of course, as always, we'll have market news and we will have investment features for you. And remember, look at all the social media sites that we are on. That will be Facebook, LinkedIn, wherever we are. There will be articles. We will be answering your questions. Just send them to us at FOMO@MyStockScanner.com, and we'll try to get all the answers to you. Well, we're at the end of the road for today. I think that taking into consideration that Hans-Henrik was out, we did okay, didn't we, Liam?
I think it's a better show without him, to be honest.
Well, you take that up with him. I won't say anything. That's it for this Monday's My Stock Scanner Live. Remember, start your week strong. Ask the right question. Quality, upside, and timing. Smarter picks, less stress, and a clearer path ahead. We'll see you on Wednesday at 12 o'clock. Happy investing all. See you, Liam.